Are you a swing or position trader and want to learn how to turbocharge your monthly returns using covered calls? Well, today I'm going to show you exactly how to select the optimal strike price and expiration for your desired returns. Stay tuned. It's mastertrader.com. I'm Dan Gibby at Master Trader, and I've been actively trading options for over 25 years. Be sure to subscribe to the channel if you want to learn how to make money investing and trading in the markets. Today I'm going to show you how to analyze the revenue opportunities and the chart pattern to select the best strike price and expiration for your covered call. Okay, let's get started. As you know, a covered call is being long stock and short a call against it, which gives the call buyer the right to buy your stock at the agreed upon strike price on or before expiration. So it's up to the call seller to determine what strike price that he or she is willing to sell the stock in exchange for the premium that he puts in his pocket. The higher the price, meaning the further out of the money it is, the less premium that the call seller is going to receive. So there's a trade-off there. The goal is to sell the strike price where the stock will just close below at expiration so that it is worthless to the call buyer and 100% profit to the call seller. And we use charts at Master Trader to determine that level. Some people who don't want to be bothered with charts or just want a simple routine method, they just sell roughly the 30-31 delta out of the money call options every month because they just want to be simple. And there's nothing wrong with that approach either. There's just a trade-off in selecting both the strike price and the expiration of the max gain that you're going to receive if it's assigned, and how much premium that's going to go into your pocket in exchange for you agreeing to sell your stock. Here's the Facebook example we looked at in an earlier lesson in this covered call series, so feel free to check out the playlist for the other parts to this series. But as you recall, a covered call in this example, we bought the stock at $115.05 and we sold a $125 call option for a net debit of $113.50. Here's our quotes for the calls when we did it. It had 39 days to expiration, and the 125 calls, you see we're trading at 154 by 157, so that's where we got our 155 a share. So it reduced our cost basis, giving us a higher probability of profit. And the maximum gain on this particular trade is if it closed above 125 and was called away, it was exercised, and you had to sell your stock at 125. So your maximum gain would be the 125 less your cost basis of 113.50. That's 11.50 a share. Now what if instead you were not as bullish on this chart and were willing to sell the 120 calls for $3 a share? So instead of taking $155 a share, you take in $3, which would lower your basis to 112.05. Now, if you then were assigned and had to sell the stock at the 120 strike price, your maximum gain is 120 sales price less your basis of 112.05. Instead, let's say you were super bullish on this pattern and you did not want to sell your Facebook at 120 or 125, but you were willing to sell it at 130. Because if you got in at 115, 130 is a $15 gain. So you go to your quote screen and they say that you would, we always try to get midpoint. So let's just say 74 cents a share. We get 1 cent improvement on a 3 cent wide spread. So your cost basis would be 115.05 less 74 cents a share, and then if you had to sell it at 130, then you can calculate it. It's sales price less cost basis. Now selecting the proper expiration for this covered call. Expiration is the date the option expires and can no longer be traded. Options which expire in the money are automatically exercised if it's in the money by 1 penny. Longer dated options are obviously going to have more premium because of time decay, and options cost money. We like 7 to 45 days as our sweet spot for selling options and legging into these covered calls. So it really just depends on how active you want to be in managing these. And again, some routinely just sell monthly covered calls. As I mentioned, the one standard deviation out, they just go to their option quote screen, pick a 0.30 delta out of the money option and just sell it. And there's nothing wrong with that either. Just, again, the trade-off and how active you want to be. Don't forget to download our free ebook on covered calls. That's a phenomenal document here that will show you how to trade this strategy immediately and easy to give you a higher probability of profit and to generate that monthly return. The link is posted here and also in the link in the comments section below. That's all for this video. Be sure to grab our free covered call ebook. It's really going to help you make money easier than you imagined. The link is also posted in the comments section below where you can leave any questions you might have. And keep watching these videos here. We've got a ton of great content on the channel to help you make money investing and trading in the markets. Thanks so much for watching. Happy trading, and see you next time.